Rate My Portfolio is the topic of today's presentation. And the gentleman whose portfolio we're going to look at today, Drew, he's 35 years old. He's from Germany. And that's not his picture. We just utilized a big stock photo picture there of a gentleman who's not nearly as good looking as Drew is. So first, some housekeeping. This is the first in our Rate My Portfolio series of videos that we're going to do. What we plan to offer is our paying subscribers a review of their assets if they like. We'll keep things anonymous, and of course we'll stick to weightings because the amount of money that somebody has saved or is saving is relative to other people. So it's much better when you just focus on things holistically without getting into dollar values. Half our audience is international, so we're going to avoid discussions of tax law. Drew is actually from Belgium and working in Germany, and that may pose some complexities here. When we talk about what Drew has invested in or what he ought to do, we're going to try to guide, not dictate. And we're going to, of course, adhere to just basic principles of investing, such as diversification. Now, to introduce Drew a bit, as I said, he's Belgian, he's working in Germany, and at 35 years old, he has about, let's say, 30 years to retirement or so. He uses a Dutch broker called DeGiro, and I don't know much about that firm, but obviously when you're investing, you want to make sure that the brokerage outfits that you're choosing are fairly notable and legitimate, and that's why I'm just going to drop that caveat there. Drew, in his own words, I'm a newbie investor that has made many mistakes, so that's good. He's realizing that we all go through this period of mistake making. He says his risk tolerance fluctuates. Well, that should be actually moving in a linear fashion. We'll talk about that. He says he was lucky to buy some blue chip stocks and have been holding them for a long time. I use them as my tent pole. In other words, these are the assets that he looks to try to duplicate those sorts of returns that he's enjoyed. He says here, after not investing for a long time, I became very risky. Crypto solid state battery. So Drew actually has a small crypto investment that I kept out of this analysis. He's down a fair amount of money on that, and that's no surprise. You really shouldn't look at crypto as an investment. I'd say if you had more wealth than you knew what to do with and you were bored on the weekends, maybe you could tool around with it. That's about all that crypto is good for right now. And of course, we have a small position in Bitcoin, and there's a case that we've made for that, and I mean very small. That's a different conversation. Drew says, now I still like to take risks, but they are more calculated. In other words, he's learning as he goes along. The good part is that Drew is saving money every month, about 40% of his income. That's very impressive. Half he's saving into a cash stockpile for property. The other half he's investing. So when we look at what Investopedia says about the basic principles of investing, it's to gradually reduce your risk as you get older. So instead of having your risk fluctuate around, Drew, you want to make sure that you're reducing it as you age. And that makes sense when you consider retirees don't have the luxury of waiting or the capital for the market to bounce back after a dip. So the dilemma that you face is figuring out how safe you should be relative to the stage of life you're in at any given point in time. So the traditional advice that you'll get, bog standard from financial advisors, take your age minus 100, and that's how much you should have in stocks with the remainder in fixed income. So Drew should have 65% of his assets in stocks, 35% in fixed income. What does he have today? Well, he has 55% in stocks. These are mainly U.S. tech stocks, 45% in cash that he's saving for a realty purchase. And his plan there is to save up a significant amount of cash, about 3 times more than what he has saved already, and allocate about a third of that to a fixed cash savings that he wants to hold, a emergency fund, if you will, for whatever reason. We don't question why people want to make those allocations. We just help them move towards that. And the remainder he's going to use for property. Now, rental income, so he plans to get an apartment and rent it out, that will typically match inflation while bond coupons stay fixed. So he's going to roughly split, as we said, his savings, the new money coming in, between investing in stocks and cash. Now, I'm making a mental note here to do a piece on bonds because that's an entirely different conversation, but this is the direction that Drew is taking. So when we look at Drew's stocks, 60% of his portfolio is in 2 stocks, Microsoft and Amazon. Now, relative to all other tech stocks, Microsoft has a lower beta of less than 1. And if you don't understand the concept of beta, it's really the extent to which you're going to sleep well at night with a stock that you own relative to the market movement. So if the market was cut in half tomorrow, a beta of 1 would also be cut in half. A beta of less than 1 would be less than half. But also that the same holds true on the upside, right? So if the market doubled, then a lower beta stock wouldn't go up as much. So it's really reducing risk and volatility. Think about what bets Drew's making here in Microsoft. So it's not just Microsoft, the company. It's U.S. large caps, right? Very large caps. U.S. technology sector, and the U.S., right? So he's making a big bet on all three. Performance attribution can explain where the performance is coming from, and there's tools they build. I used to work for a firm that built those sorts of tools to look at exactly where performance is coming from. Now, when we look at what Drew ought to be invested in, MSCI ACWI here, this is an index that represents 85% of the global investable equity opportunity set. So you say this is 85% of all stocks in the world are collected here. It's across 23 developed markets and 24 emerging markets. So that's 47 countries. And you can see that United States makes up about 63%. So all things being equal, Drew having 100% exposure to the United States in his equities is an overexposed to the United States, and he's nearly all in information technology. So you see that ideally he should be about 22%. So there's an opportunity cost associated with that. He's missing out potentially on the other sectors, and we would presume he's bullish. Now, it's been historically a good idea to bet on the United States. Here you can see on the far right, you see where it says since December 31st, 1987. That's the return of MSCI USA versus the world versus ACWI. ACWI includes emerging markets. The world only has developed markets. So you can see that developed markets have slightly outperformed both emerging and developed, and the U.S. has outperformed any of the others. So when we look at the 20-year return of Microsoft, his biggest holding, it's important to benchmark it appropriately, and we simply took here Microsoft 1,108% over the past this looks like 20 years. And then pink, that's QQQ, that's NASDAQ, all right, so 918%, all the companies that trade on NASDAQ, and the tech sector, 786%. So holding Microsoft has been good, at least based on these, I think, appropriate benchmarks. Now, when we look at the bigger picture of Drew's portfolio here, what I've done, first of all, I've pulled this into Excel and used the Refinitiv plugin, and it provides industry. So some of these, will differ from, let's say, a GICS classification, but it's the basic idea here is to start grouping these stocks that he's holding. You can see that Microsoft, they're at a 36% weighting, and Amazon at a 25% weighting. So his 60%, as we said, of his portfolio in those two firms. But when you look at those percentages, you need to consider them in the context of all the assets that Drew has, not just his stock portfolio. If we do that, then we add in his cash. Microsoft's still about 20%. I think a rule of thumb is that you shouldn't have a single stock account for more than 10% of your net worth. I think any financial advisor out there would think that was a reasonable rule to follow. Then we go down the list here. We see some other names, Alphabet, Dynatrace. So he's got some SaaS firms in here. Some more risky stocks, QuantumScape. I don't know if they have revenues yet. But what you want to do with this list of companies is try to break them down in terms of safe versus risky. And this is what we've done with our own portfolio. And you could think to yourself, it starts raising some questions. Are the largest companies in the world safe? Well, we would think that it's risky when you invest a lot of your wealth into a single stock and overexpose. So most of Drew's portfolio would be risky in that respect. Any position then of, let's say, greater than 10% of your total assets would be considered risky. Well, is cash an alternative asset? Perhaps. So then we can then break down Drew's his portfolio and his cash into these buckets. What you need to think about also are overlaps. So you would have seen in the previous set of holdings this acronym UCITS. It refers to investment funds regulated at the European Union level. So those in the EU who are investing, you don't have the same access to products that people do in the States. So your ETFs would probably all have this label UCITS. When we look at the ETFs that Drew's holding, 8.5% of his stock portfolio is in ETFs. Nearly all of that is in the S&P 500 information technology sector ETF. That's not providing you any diversification. You're essentially just investing in the same thing as you are with the larger companies. So you have that exposure, and then you've overweighted the information tech. So you're just very heavy on U.S. information technology. That ETF isn't providing much diversification. The MSCI World ETF that he's holding a little bit of, that's better, but it's also 69% USA. It's better because it covers all industries, but it's also weighted because it's all developed markets. The U.S. makes up nearly 70% of all developed market cap, so it's still overweight U.S. What could Drew do? Well, the ETF positions, they seem redundant. So I think no single stock should be more than 10% of someone's net worth. So since he's comfortable, he said that, with his largest positions, just leave him then. Take all the money that you're putting in every month and buy anything but U.S. tech. So start to reduce your exposure to U.S. tech. That MSCI World ETF you're holding, that seems fine. So it's 69% U.S., 21% tech. So you're getting a lot more exposure to other sectors than just tech. You could look at regional ETFs, Europe, Asia, or ex-USA ETFs like this one. This is very interesting. It's MSCI ACWI, so that's all country world index, all the 40 some odd countries we described earlier, minus the US. And look what happens here. All that tech drops off, or let's say a lot of that tech drops off. You have overweighting financials there, and Japan at the top, UK, China, you can read down the list. But this is an example. Of course, it would have to have a UCITS version, but an example of the sorts of ETFs out there that you can use to get exposure to global assets or particular groupings of assets. Speaking of groupings, Drew, you need to take your stock portfolio. You probably have already done this, I would hope. Take that export from your broker and then just create a simple spreadsheet where everything's grouped. So I've done that here. You got large cap tech, 70%, SaaS companies, 9%, other, 13%. In that other bucket, go through there and think about why you're invested in every single one of those names. Is it just something that you read an article about and you thought was interesting, or you saw other people talking about it? Really think about your convictions and do that across, all your firms. Though you did say your larger holdings you have strong conviction in. But on a side note, I noticed you're holding Western Union, $5 billion market cap. That's remarkable that they're that small. And I took a peek at their stock chart. They've been going down quite a bit. So I'm curious. We actually have a video teed up on, I think it's TransferWise versus Western Union. So stay tuned for that. But then, as I mentioned, your ETFs here, that tech sector one seems redundant. So put together a spreadsheet. List out each asset class you hold by type, so cash, stock portfolio, real estate. That puts your weights into context. And you mentioned that the German government offers some retirement options. And I didn't go down this path very much with Drew because we had limited time, but he also has a pension component. And Drew, you've got to understand exactly what's in that. So his answer to that question was, well, he's not entirely sure how the government's allocating those funds. And I understand having a number of pensions myself from different locations and different companies, it's very difficult sometimes to access that information. But get on top of that and identify what that is and stick it in this spreadsheet. These funds will provide you with diversification. You mentioned match. Boy, anytime an employer matches money, you max that out. That's free money. It's very important. Of course, if they're matching at 5% or something, maybe that's a different story. But match typically means 1 for 1. Come up with something like this. This is your asset class allocation, your tech stock portfolio, then your cash, your properties at zero because you haven't bought that yet, right? Your cash is going to go up quite a bit. Then it's going to slip over to property and cash will dump down. Then you have your government pension. I don't know what that is. I just plug this in. And other things, right, that you have which would be considered assets over time. So just to conclude here, don't hold stocks because they're popular. You heard the names mentioned a lot. Hold them because you have strong convictions. And for example, can you describe what Nokia does to your wife over dinner? Well, I don't know what Nokia does, and that's why we have a video teed up. I couldn't tell you. I took a quick look, and I was very quickly lost. So always understand what you're getting yourself into. I think Nokia is one of the more requested stocks we have from our subscribers, probably for that reason. It's tough to figure out what they do these days. Set a limit on the maximum number of stocks you can hold. It isn't a problem for you right now, but make sure you do that. What it does is it makes you start to do relative analysis. So for example, those buckets earlier, you had the SaaS companies. Ask yourself this: I'm holding 5 SaaS companies. Are those the best 5 I could be holding? Right? And I don't know what the answer to that question is, but when you ask yourself that, then you start thinking about other opportunity costs, right? That based on the assets that you're holding, you're forced to do comparative analysis. Remember, Drew, it's important. The process of wealth creation is rarely exciting, but it is rewarding. So keep track of these things, and it starts to become very fun as you grow your wealth. And great job of saving that much of your income. You're well on your way to having more wealth than you do now when you retire. So I'm going to put up another video here. This is some timeless advice about investing. Before you watch that, please click the Nanalyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.